Well, joining us more now is Tim Richardson from Pengana. It's great to catch up with you again as we, of course, well and truly underway in 2025. And my goodness, very much a focus on AI, those tech-related stocks, given what happened in the past 24 hours or so. What's your takeout from what we've actually seen happen in the market?
What the market has got concerned about is the increased efficiency that the AI model that's been delivered by DeepSeek is going to have on the demand for computing power, and therefore on the demand for the most advanced chips, which has got obvious implications for the earnings growth for some of those big companies. The thing we probably should remember is that the semiconductor industry is still very immature, so it's pretty unclear how that's going to evolve and where the threats to it are going to come from over time.
I mean, the question for investors, given the emergence of this supposedly low-cost model, is that they've over-capitalised essentially.
There's certainly been some huge sums invested. You saw the announcement from Meta just last week for the new AI data centers that it's Stargate, yeah. and Stargate as well. To what extent that's actually been financed is a little bit unclear, but there's clearly a lot of funds have gone into these projects. What remains really unclear, I think, is to what extent this greater efficiency is going to lead to lower demand for computing power, and therefore the more advanced chips, or whether, as Jeevan's paradigm suggests, what you'll see is that the greater efficiency leads to lower unit costs, which in turn can actually increase the demand for computing power and bring a burst of energy into AI innovation.
Something that I know, and particularly when we take a look at a company like NVIDIA and likely demand, do you have a particular view of whether this has actually changed the outlook?
It remains to be seen to what extent it's going. This is going to impact the demand for computing power, and any analysis that comes up with a definitive answer should be treated with a fair degree of scepticism. But what you've seen is companies like NVIDIA and Broadcom. They've grown their revenues and earnings and market capitalisation very, very quickly, and that's what has left them pretty vulnerable, to developments like we saw on Monday and over the weekends.
Tim, of course, we have seen very narrow leadership in the US, led by companies such as NVIDIA. So, what are the broader implications, do you think, for the share market?
Well, I think looking first at looking at the tech sector, what we like to see is a shift along the value chain, something that was underway already. We're likely to see an acceleration of that shift from hardware to software. You see companies like Adobe, Salesforce, ServiceNow, that actually outperformed. We saw the share prices move up on Monday, and they moved up again yesterday. These are the businesses that are developing the applications that are going to drive the labour productivity and therefore the earnings growth of their enterprise customers, and they stand to really benefit if the development of AI becomes more efficient and more cheaper over time. And perhaps looking at beyond the technology sector, I think probably in the short term, it's not necessarily going to change the game in the short term. What you saw on Monday in the carnage in the semiconductors was things like healthcare and consumer stocks. They held up perfectly fine, so there's no obvious reason to suggest this should logically be the start of a major correction after what's been a fairly steep climb over the last year or two. But what you're likely to see is as the barriers to entry into AI come down, you're likely to see more innovation and it becoming more effective for a much wider range of companies across the economy to either develop AI tools or take applications and apply them to their existing model to reduce costs, increase revenue to grow earnings.
All right, so if you're an investor, don't panic, obviously. Do you need to make subtle changes though, do you think?
I think what this episode has told us, it just reinforces the truism that a diversified portfolio of quality companies is the most appropriate way for investors to get exposure to the global equity market. Particularly if we're seeing a broadening out of the AI winners. Regarding semiconductor stocks, as I said, I think it's too early to come to a definite conclusion. If we're seeing greater efficiency in AI innovation, which may mean less computing power is required to develop large language models. That may still be a benefit if demand increases for the hyperscalers that run the data centers. Looking more broadly and probably more interesting, as I've touched on, I think the investors should actively look for high quality software businesses that are developing the AI applications that are going to help businesses to reduce costs, grow revenue over time. And beyond that, looking outside of technology, I think investors need to look carefully at how businesses are taking advantage of falling costs of AI to adapt them to their business models to improve their earnings growth.
And Tim, aside from what we're seeing on the corporate front, a big week as far as the macro moves of central banks. We've got a raft of central banks, including the Fed, the ECB, and then we look ahead, of course, to our own Reserve Bank off the back of inflation data. How mindful are you about what we're likely to see from the central banks and the movement of interest rates?
I think starting with the Fed. The Fed is established a well-trodden path of signalling to markets what it's going to do, and it would come as a great surprise if the Fed were to do anything this week. Over time, rates are likely to move lower before they move higher, but of course the extent of the cuts in interest rates are now much less certain, with a number of policy choices that the new US administration is likely to make are likely to be potentially more inflationary.